is Bernie Madoff, who's the chairman of Bernard L. Madoff Investment Securities, LLC, which he founded in 1960. That name may not say a lot to you, but you go over to Madoff and you talk to Bernie and he mentions, oh, by the way, 10% of stocks traded in the United States are going through this firm right now. It's one of those really important parts of our financial system that doesn't show up in the headlines, that most people don't, outside of markets, don't understand the role it plays, but it's a major factor in American and global financial markets today. And next to him is Josh Stampfli, who's the head of automated market making group at Bernard Madoff Investment Securities. He designed the, I'm going to just read the sentence right here because it's so beautiful. He designed the trading logic to manage position risk and handle the order flow inherent to the firm's business of providing liquidity to its customers. He's going to explain what that means in a little bit.
You have to understand, Wall Street is one big turf war. So, as Elsa just said, by benefiting one person, you're disadvantaging another person. And the basic concept of Wall Street, which sometimes the regulators lose sight of, as do the academics, is it's a for-profit enterprise. You know, in every aspect of it, the person that is buying a share of stock is convinced he knows something that the other person who's selling it to him does not know. There's no zero-sum game in Wall Street. So when Bob first started to look at market structure, whether it be macro market structure or micro macro structure, and he started asking questions of the established ways that business was done in Wall Street, no one wanted to deal with that because everybody was very happy with the way things were. You know, commission rates were 80% higher than they presently are today. Everybody was making a very good living. Regulatory.
So commissions have, even since deregulation, obviously at deregulation they dropped a ton, but they've kept dropping since then?
Well, they've gone down to virtually nothing. So what you have now, outside of Mickey and a number of firms, other discount firms like hers, nobody really wants to do retail business any longer because nobody wants to do business for 5 cents a share when it used to be 75 cents a share. And Wall Street, so just so you understand the scope of it, is one of the few industries where the cost of doing business for the consumer has gone down dramatically from a commission standpoint. Yet the expenses of doing business from the industry's perspective has dramatically increased. And the cost of regulation has dramatically increased. Now, no one's going to run a benefit for Wall Street. So whenever I go down to Washington and meet with the SEC and complain to them that the industry is either overregulated or the burdens are too great, they all start to roll their eyes, just like all of our children do whenever we talk about the good old days.
Well, you sort of raise this question, which is, okay, commissions are almost nothing, and yet you are a for-profit enterprise, and maybe we can bring Josh into it too. How do you guys make money then?
Well, today, basically, the big money on Wall Street is made by taking risk. That's where, and that was sort of, firms were driven into that business, including us, because if you couldn't make money charging commissions, primarily because the rates were lower, as I said, and the infrastructure costs, particularly the technology and the regulatory infrastructure you had to have dealing with clients. Everyone said, listen, I might as well risk my own capital and trade. So if you looked at the earnings reports of the firms like Goldman Sachs,